You're listening to the Millionacres Podcast. Our mission at Millionacres is to educate and empower investors to make great decisions and achieve real estate investing success. We provide regular content and perspective for everyone, from those just starting out to seasoned pros with decades of experience. At Millionacres, we work every day to help you demystify real estate investing,
Hello, I'm Deidre Woolard, an editor at Millionacres, and thank you so much for tuning into the Millionacres Podcast. I've been on a mission lately to talk to leaders from all the top crowdfunding websites and find out what their journey's been like in the past year, what they see about the future, because I certainly see great things. I'm excited today to be talking to Jesse Stein, who's the head of real estate at Republic, which is an alternative investment platform that's open to all investors. They have over 2 million active users. They've closed over $500 million in investments. They've got some new products that I think are really interesting. So for the first half of the podcast, I'm going to be talking to Jesse, and then for the second half, I'm going to talk to Jesse and the team from Nada Homes and their partnership with Republic on Cityfunds. Well, welcome, Jesse.
Thanks, Deidre. Happy to be here. Thanks for having me.
Well, I feel like you kind of have had this front row seat to everything that's happening in real estate crowdfunding, which over the last, couple years has just been amazing. What are you seeing right now as things evolve?
I mean, a couple things pop to mind. First, I'm very surprised by the interest by institutional sponsors in wanting to consider and use crowdfunding as a way to raise capital. Almost everyone we speak to believes that raising capital online is the future, and there are a lot of firms that are looking to get in early and build that brand recognition and start building that investor network that they can continue to grow and benefit from in the future. We've seen in the public markets how there's been this retail revolution and this has really sped up this interest level where, online capital raising, it's going to provide, an additional catalyst for these companies to continue to grow their assets under management. And second, I've been very, amazed at the innovation by the sponsors that are using crowdfunding. It's not just your typical real estate investment products. I think both sponsors and investors realize that real estate investing has been available to the crowd for 30 years since the advent of the current the REITs that started to go public in the early 90s. But the real revolution here for real estate crowdfunding is the creation of these unique products that fill the void for real estate products that don't exist in the public markets.
Well, I think that's one of the things that's really interesting that you're doing is that you've been thinking about it from a product perspective. In terms of the sponsors and developers, have you seen a rapid uptick in sponsors and developers being interested in using crowdfunding?
100%. Even those sponsors that believe it's early, where the amount of capital that they can raise through crowdfunding is not necessarily a meaningful amount for the type of transactions that they're doing, they do want to establish that retail network. And, Blackstone really was the first to market, of the big private equity firms to say, hey, we can raise an unlimited amount of capital from institutional investors, but we're going to start raising from retail as well. And they brought their non-traded REIT to market a few years back. There were a number of, their peers that came with similar products. And you're going to start to see the same thing within crowdfunding, where the quality of sponsors will continue to grow. And all of a sudden, it's going to be, hey, well, if this group is doing it, maybe that's something I should look into as well. And we're starting to see the shift away from, we're still going to have, your mom and pop real estate sponsors, developers, property owners. This is a great way for them to raise capital if they don't have those, institutional investor networks. But we're also seeing the more established asset managers and sponsors who are looking at this as a way to complement their institutional capital raising strategy.
Interesting. So I know one of the things that's been important for Republic is creating opportunities for non-accredited investors. One of the things that I hear from non-accredited investors sometimes is they get a little frustrated about not being able to be involved in some deals. So why was it so important for you to focus on really opening things up for everyone?
Yeah, that's really the core basis of the Republic platform. I mean, one of our taglines is power to the people. And, it is a little frustrating that the definition of accredited investor, which was created, decades ago, is still in play today, considering there's just such an equal access to research and information, regardless of an investor's net worth or income. You would think that the SEC, who made a slight adjustment to the definition last year, would have gone a few steps further and really, allow people to invest, whether it's based on sophistication or knowledge, or, totally eliminate the income and wealth considerations. Hopefully the entire concept is reconsidered at some point, but, for now it does create a regulatory barrier for non-accredited investors looking to participate in certain offerings.
Yeah, that's true. I understand in theory why it exists, but I also understand why it's so frustrating. And that's why I think the step that they made last year to make it a little bit more knowledge-based was a good step in the right direction, but still a really big gate for people to get through.
It is. And I mean, they showed that they understand that conceptually it doesn't necessarily make sense, but weren't really willing to give up some of the investor protections that the rule is meant to. For real estate, I believe that it's even more important for non-accredited investors to be able to participate in these type of offerings, because in addition to the economic aspects of real estate, where it has been proven over the course of centuries as a great way to build long-term wealth, allowing non-accredited, accredited investors to participate in these real estate offerings, you have that pride of ownership in real estate, where you could walk past a building or be in a neighborhood and say, hey, I own property here, as well as provide the ability to support local communities, or in the case of city funds, invest in markets that people like, whether it's because they live there, they visited there, or it's a market that they just want to participate in. So our vision at Republic and at City Funds as well is to allow as many people as possible to participate in these type of products.
I love that pride of ownership thing. One of the things that we've learned through having the Mogul service is we've had some of our investors take pictures of themselves at the buildings, crowdfunding projects they're participating in. They're really excited about it because they have that pride of ownership. Well, let's talk a little bit about Republic's mobile app, because I think that is so smart. I think a couple of companies haven't really gotten kind of on the boat yet with developing those mobile platforms. Do you feel like investors are much more comfortable now using mobile in a way that they weren't even maybe 3 or 4 years ago?
100%, and you look at public market trading companies like Robinhood or Public that were mobile first platforms, and were obviously able to grow really significant user bases. And regardless of a demographic, people are spending an enormous amount of their time on their phones, and it's also it's sometimes the preferred medium, even when a computer or laptop is just as easily accessible. People do prefer to research, browse and transact through their mobile devices. I think at Republic, a lot of people have this perception that our user base is skewed to the very young side, right? These are 20-somethings who are always mobile, and that's why they're investing in, these startup companies that Republic specializes in. But the reality is that our user base is actually older than what Robinhood's typical user base, and 35 to 50 demographic is our biggest constituency.
Well, one of the things I like about Republic, and maybe that's part of why this has that reputation, is that it's innovative. So I wanted to ask you about crypto and tokenization. I know you've been sort of studying that. I'm really fascinated by this. Tokenization, I feel like in real estate had started years ago, but it never really has taken off the way that I kind of thought it would. What are you thinking right now about the role of crypto in real estate?
100%. And, our blockchain advisory group is one of the most prominent groups in the industry. So, we're at the front lines of everything that's going on in the crypto space. And what I would say is that the two industries haven't really figured it out. where, like you said, for years we were reading about how tokenization is going to revolutionize real estate and it's going to provide all of these benefits. The reality is that, tokenizing an asset or the equity of an asset for the sake of tokenization, it doesn't do anything. The bottleneck around innovation in real estate and real estate capital markets was not a technological problem that blockchain solves, right? The restrictions on innovation are typically regulatory related. And you just haven't seen that adoption because by tokenizing your asset in real estate, you don't get that marketing benefit that you think you would get. And you might lose more typical real estate investors than you actually gain in crypto investors. And crypto investors, they're not looking for an 8-10% stable return on an investment. They're looking for 1,000x over the course of a month, or at least, the chance of that, right? So when you come to them with a very safe, secure, stable asset that doesn't have the potential to produce those type of returns, it's just not that interesting to them. So I do think there is something big to be done with tokenization, blockchain, and real estate. We're working with our blockchain group on developing some products that we think might make sense and are truly innovative. Nothing we can discuss at this time, but exactly to your point, it hasn't taken off the way that everybody thought it would, a few years back.
One thing I've noticed that kind of has taken off or at least gotten legitimized is Bitcoin. I noticed UWM announced this week that they're looking to accept Bitcoin for mortgages. Used to be that in real estate, accepting Bitcoin for the sale of a property was kind of a publicity stunt. It was one I used when I was working in PR. Do you feel like that Bitcoin itself is becoming more legitimate within real estate, sort of separate from crypto?
Not necessarily. I think you still have, property sellers that use it the way that you described as a publicity stunt to say, hey, we now accept Bitcoin. You have to keep in mind that from a tax perspective, when someone uses their Bitcoin to buy an asset, it's a lot different transaction than if they're using cash, right? They do have to pay capital gains or potentially losses on that Bitcoin, conversion to whatever asset they're acquiring. So it is a bit of a different animal. I do think the use of digital currency, whether that's stable coins or, something that a government might create, has the opportunity to potentially assist in real estate transactions and make those easier, more efficient. But I think Bitcoin is, I think that the greatest value that Bitcoin has provided to real estate is by making a whole lot of people very rich. And when they realize that they're set for life, or they're so rich that, hey, maybe I should diversify into different assets, it's often real estate that they want to put their money into. So Bitcoin helps as far as it's created a lot of wealth that ultimately will flow or has flown to real estate.
That is an excellent point. I have definitely seen that a lot of people who wanted to get out of their Bitcoin, they immediately went to real estate. And, I always love to see that. Let's talk about some of the things that I feel like most investors want to know right now, which is interest rate changes, potential concerns about that, possibility for inflation, global uncertainty. How much is all of the sort of swirl of news that's happening right now impacting Republic, and how do you kind of separate signal from noise?
I think you have to think about it based on which sector you're investing in, what asset type, what location, because macro level events and changes in the economy are going to impact each of those a little bit differently, right? So let's take inflation, for example, and rising interest rates, and assume that those happen at the same time. For sectors like residential or hospitality, where that inflationary pressure can be passed along to a tenant or a person staying at a hotel, those sectors are not as negatively impacted by inflation and rising interest rates the same way that a net lease property or an office building with long-term leases or a retail building with long-term leases would be, where those properties are really trading on a multiple of income and react similarly to fixed income products. And then from a market perspective, you have to think, okay, if inflation and rent growth and home price appreciation continue along the same line, which of these markets can continue to attract demand if prices go up? And that's where you have to look at, what are the jobs in this market, right? Are these jobs that are also going to increase as income as home prices, right? So a market like Austin is a good example. There's so much migration to Austin and so many companies moving to Austin, and these are well-paying high-tech jobs where we've seen as Austin prices appreciate, income levels have been able to been maintained in a similar ratio where there's just continued demand even at those higher prices.
Well, I think that is a perfect segue to start talking about Cityfunds. So let's take a quick break here and we'll come back and talk about that.
Like what you're hearing? Get more real estate investing news and advice from Millionacres on Instagram at Millionacres and on Twitter at Millionacres_co.
During our break today, we are excited to have Millionacres lead investment analyst Matt Argersinger here to speak briefly about one of our newest services, Real Estate Winners. Thank you for joining us, Matt.
Thanks for having me.
So what is Real Estate Winners and who is it for?
Well, I like to think of Real Estate Winners as our answer to Stock Advisor in the real estate market. It is a service that provides recommendations on publicly traded real estate investment trusts and real estate companies. So it's a pretty big universe out there. There's over 200 REITs to choose from, and probably dozens, if not hundreds, of real estate companies are in our universe. And we provide regular investment recommendations as well as commentary on the market, educational material, and it's really designed to get anyone who's interested in investing and learning about real estate started.
So is it geared toward new investors or is it more for seasoned pros?
I think Real Estate Winners can serve both. I think if you're a new investor, maybe you're just getting started with stocks and you want to learn more about how to add real estate to your portfolio, great place to start. If you're a seasoned investor and just thinking, okay, how can I diversify my portfolio, maybe reduce the volatility in my portfolio, maybe add some income to my portfolio, then I think Real Estate Winners is a great solution for that cohort as well.
Fantastic. What are the benefits of being a member of Real Estate Winners?
Number one benefit is day one when you join, you get our top 10 investment ideas at the moment. So really right from the beginning, you know what our 10 best ideas in the publicly traded real estate market are. And then going forward on a monthly basis, you'll get a new recommendation, sometimes more than one new recommendation, as well as regular content that we're coming out. We're covering our past recommendations, providing updates, and talking about the real estate market. So it's really the full package.
Perfect. So what do you need to get started?
Really all you need is a discount brokerage account. So if you're used to buying stocks, and you probably already have that. If you haven't bought stocks in the past, of course, just open a discount brokerage account. These days, you don't even have to pay commissions. It's fantastic. So it really couldn't be easier to get started investing with Real Estate Winners.
Sounds fantastic. So how can people sign up?
Sure. They can head over to real.fool.com. That's real.fool.com.
Great. Thank you so much, Matt. Welcome back, and for the second half of the podcast, we're going to talk about Cityfunds and Republic's partnership with NADA. NADA is a real estate service and finance company. It's committed to making home ownership more accessible and affordable for everyone by building solutions for anyone looking to sell, buy, finance, trade, or invest in real estate. So I'm here with John Green and Mauricio Delgado, along with Jesse, to tell us more. So let's get right into it. Let's talk about Cityfunds. I think it's kind of an extraordinary idea. How exactly do these funds work?
So I'll take that one. So city funds are city-specific real estate funds that invest exclusively in single-family residential properties in a given market. This makes it a unique product in that it provides a targeted exposure to a city's residential real estate market through a diversified portfolio of properties. Now, this is something that does not exist in the public markets and goes to the point I made earlier with, you have to bring unique products to market in this space rather than try and replicate something that already exists in the public market. And, the multifamily or even single family residential REITs in the public markets, those are very much have broad geographic diversification. So this concept of the city fund, it's something I've been personally working on for years. And it's rooted in the fact that I've lived in New York my whole life. I've seen many, many people become extremely wealthy just by owning real estate. And these are not sophisticated investors. These are people that know very little about real estate. But the point is that by participating in the market and letting the market do its work and appreciate over time, there's tremendous wealth that can be created just through the ownership of real estate. And the product was created to allow a much broader group of people to be able to participate in this long-term appreciation and wealth creation.
So how did this partnership form? How did these two companies connect?
So we got to know John Mauricio and the NADA team as they were running their campaign for NADA on Republic. We started talking about creating this type of product, and it really was a perfect fit because of the home shares product that they had created. And this was really what I think is the missing piece to the City Fund product. The fact that we can take a pool of capital and distribute that amongst a diversified portfolio of assets and not have to deal with the burdens of property management for those assets, it was really just a perfect fit. Now, these city funds, these are vehicles that are focused on providing an index-type return based on market performance. And together with the home shares product, it gives us the ability to build a real diversified portfolio with a limited amount of capital, and is just a perfect way for us to be able to build and scale the city funds.
From NADA's perspective, just to piggyback on Jesse's remarks, the partnership was a no-brainer. As we get to know Jesse and the team, there was very much a natural alignment in mission and vision and values, as well as product fit. So bringing this investment product to market together, for us is a way of furthering now our shared mission to democratize access to the largest asset class in the world.
Interesting. So you've got two companies. How did the two of you get together and choose your first cities? Were you sharing data together? Did you already have cities in mind?
It was very much a collaborative effort. So we did arrive at the first three cities of Austin, Dallas, and Miami. And I'd say really based on two primary factors. One, you have historical market performance. Home prices in each of these cities have increased by 100% or more over the last 10 years, with strong signals for forward-looking projections. And two, they each have diverse characteristics. Each city has its own unique identity, which is well supported by strong demographic and economic factors. So the combination of performance and the unique aspect we thought was something that made a lot of sense.
Well, Jesse had talked about Austin earlier. I looked on the site and looked at the city funds. I know that Austin is the city that has had the most investment dollars so far in people investing in the city funds. I know the buzz about Austin is just crazy. I feel like I'm talking to people about Austin all the time. Is that what you're seeing, is that people really have wanted to get into that market and hadn't had a way to get in until now?
Yeah, that's a great question. The buzz has definitely been a positive factor. You have Elon Musk predicting that Austin will be the biggest boom town in the last 50 years. And then more recently, you have Zillow recently reported that home values in Austin have actually increased by nearly 40% since July of last year. So the buzz and just the market trends have been very, very supportive for that.
Is it also very hard to invest in that area, though? There was a Redfin report out recently that said that Austin is the city where people have paid the most over asking, 6 figures over asking in some cases. So does that make it a challenging environment for you on the buying side?
Yeah, of course. I mean, that's, in its most simplistic way of looking at a market, it's really a supply-demand issue. There's more demand than there is supply, and Austin's a great market for that. That's where one of the benefits of city funds is that we do invest alongside homeowners with our home equity investments. So that does unlock access to a substantial amount of inventory within these markets. And then for Nada, because we are a retail consumer model to where we offer real estate service, we do have a boots on the ground real estate sales team in that market that does give us an advantage in sourcing and identifying opportunistic on-market as well as off-market properties. But there is a limited supply for sure.
So you're invested in Austin, you're invested in Dallas, also City Fund in Miami. How fast are you planning to roll out other cities, and what cities are you looking at next?
Yeah, we can't speak generally to it, and the market's going to dictate the traction and acceleration of how many we release. But so far, we have circled this year for 4 new cities to be launched. We have Phoenix, Nashville, and Tampa that we're focused on. And then for the 4th city, we actually we've released a new feature on our site to allow users to actually go in and vote for a city fund so they can express their own demand and interest. At this time, Portland's leading as the 4th new city. So we would hope to get those out. And then, as we look forward, we've identified over 50 of what we see as the most attractive cities across the country as potential future city funds that we plan to release and scale over time.
Interesting. Well, Phoenix, I mean, the amount of people moving there, price increases last year. I think they were at the top of Case Shiller like almost every time this year. Nashville, another huge boom. Tampa, I feel like people are not necessarily appreciating how big Tampa has gotten in recent years. I think that's an interesting market as well. Those markets sound like they're mostly for the single-family rentals, but as you invest in different cities, are you planning to shift the strategy, or is it always going to be single-family and single-family rentals as the core of the strategy?
Yeah, another good question. City funds will always remain singularly focused on single-family residential. However, again, one of the most significant advantages of a city fund is that we are also investing into homeowner equity through our product that we termed home shares. So the home shares product really enables us to address a bit of a two-sided problem that we see within the real estate market. Number one, you have the ability to unlock access to the $22 trillion homeowner equity market. And that's obviously for the investors in the fund. And then 2, it also enables liquidity for homeowners in these cities. And this product is unlike taking on any new debt or requiring them to move out of their homes. So by doing so, it allows us to gain access and really to acquire assets at a pretty accelerated pace in these cities.
Interesting. So if someone is a homeowner and they're part of the home shares program, when they're ready to sell and move on, can they then sell their home into the city fund? Is that how it works or no?
City funds is looking at entire home acquisitions for the purpose of rental properties. That does introduce the optionality for a homeowner to sell an entire home into a city fund, and then we could offer a leaseback option. That would be an option. And that would be the same thing towards if you had sold a fraction of your equity via a home share product, that option would still exist.
That makes sense. So for investors in city funds, what is the exit strategy, and will there eventually be a secondary market for selling shares?
Liquidity is a key aspect of the city fund product, and our intent is to grow each of the city funds to a point where we can list it on a secondary market exchange. And the best case scenario for that would be a New York Stock Exchange or NASDAQ. But there are other options if we're not large enough at the point that we want to bring that liquidity to market for investors. And the way that we think about this is that these products are going to be really ETFs for each of the given markets, where today, there are thousands of ETFs. You can invest, thematically in any type of sector, any asset class, any investment strategy. What you can't do is invest in a city through the public markets. And, we often use ETF as an example of how we expect these products to be traded and treated as a publicly available investment product.
Interesting. It makes me wonder if, as these city funds grow and you have these different options, could you diversify by city and maybe allocate a certain amount of funds to, you're feeling bullish about Austin now, but maybe you feel like Tampa's going to be big in 5 years, so you could sort of play around and diversify within the city funds. Is that how it could work?
100%. I mean, as a liquid product, of course, you can go in and out of city funds and potentially even short a city fund if you want to make a speculative bet against a given city. But we're also building tools where, when we have more city funds, if you want to invest a certain amount and allocate funds across various city funds, you might say, okay, I want to invest $10,000 and I want 20% in Austin, 10% in Nashville, 20% in Dallas, et cetera, and build that portfolio of city funds where you're diversified, but you have this targeted exposure in each, and you can move around that allocation over time based on something you read in the paper or, data that you're presented with. It's that control over your allocation that we can provide that doesn't exist in, the geographically diversified companies like an Invitation Homes.
So within the individual city, are you thinking about expanding across the different neighborhoods? Are you targeting specific neighborhoods? Are you clustering? What's your buying strategy look like?
The city funds in particular are focused within the MSA of a city. So that does expand some opportunistic areas where we look at what I would refer to as fringe markets, such as you see coming up around where communities are coming in. So we are looking into strategies such as that in each city. That's where Nada as a company, we have real estate partners across the nation, so we're able to leverage that to get more insights into it, as well as we have data partners to help us get insights to those pockets. In that case where you're looking at what's the, if it's a rental property, what is the average rental yield forecast within that market? It's kind of this life cycle of a PUD that you can kind of predict where it's going to turn more rental and set expectations as to lesser homeowner. So we very much take data and market insights into consideration to inform our acquisitions.
Are you buying properties that are maybe as is and then fixing them up for rentals? Are you buying existing rentals or both? What is that strategy like? Yeah,
a bit of both. We're not setting aside a substantial budget. Our target for really any renovation of substance. So for Nada being a platform that is consumer-centric and consumer-focused, we have the optionality to present, for example, I spoke to this earlier, the option for a homeowner to maintain living within their home, but sell the entire home, and then we would lease it back to them. They become a tenant. So that's an option we're looking at in certain markets. But just generally speaking, we're not looking to invest in homes that require a significant amount of renovation or remodeling.
So in general, how should investors be thinking about their investment in city funds? What should they be expecting? How long should they plan to hold it?
Historically, most real estate investment vehicles are, based on actively managing or finding specific properties and then, managing them to generate alpha, above market returns. City funds was designed to as a real estate investment product, to apply a passive investment strategy across a specific geography, letting the long-term trends do the work. Being first of its kind to deploy this passive investment strategy within real estate, we believe this benefits investors in a few ways. Because of thematic and index-like and through home shares provide access to effectively mimic beta, generate beta for the market, right? We're not actively looking to hit home runs. We're just looking to get market returns. And through home shares, we're able to generate enough investments within a specific city that we believe can mimic the returns for that city without actively managing the portfolio. Because we're not actively managing the portfolio and we're aligning homeowners with investors inherently, we believe that creates this, that's what creates the self-managed assets within the fund, and that gives us the ability to offer these funds with no carried interest, low management fees, and through Republic and through our Reg CF offerings, make them accessible to all investors for as little as $500. So those are a few of the benefits that we believe are very unique to this product and for the investors in city funds.
Are there any limits on how much someone can invest, and is $500 the minimum across all of the markets?
500 is the minimum. Within the Reg CF offerings, there is a $5,000 maximum investment, but we're concurrently offering larger investments to accredited investors on the platform as well.
When you're going into a new city, what does that process look like? Is it do you have to sort of set up people in that market, or how does that begin?
So with Nada, again, it's a consumer-centric with the real estate partnerships. We do ensure that we have informed and engaged partners in those markets in advance of deploying any of this capital. We structure these partnerships as a means of an independent real estate agent partner or a direct Nada real estate team. We give them some benefits by offering the home shares product to their portfolio, as well as leverage them to source acquisitions. So we set really a target and a frame and a timeline with those partners in advance. An additional element for us is that Nada we have our own in-house title and escrow service. So we want to ensure that we have coverage within that specific area to facilitate the closings.
Interesting. So you're handling the closing. So how long does it take for the city fund to kind of ramp up?
Not long, assuming that we have personnel in place, as John mentioned, to handle the real estate operations. The way that we've structured these offerings is that each of the city funds is under a single issuer. So for us to launch a new city fund offering, 95% of the documentation has already been templated out. So it's much easier for us to bring something to market as opposed to if we were going to start something from scratch.
So I noticed on the city funds that you have days left to invest. What happens once the fund closes, and how long in general will each fund be open?
So the days left to invest is just for the regulation crowdfunding offering. And we expect that following the completion of that, whether it's by term or when we hit the maximum amount of $500,000, we'll continue to offer interest in city funds through different type of offerings, whether it's raising more capital into Austin, Dallas, and Miami, or forming new funds and opening those up for investments. From a long-term perspective, we're always going to be looking to grow the city funds and to continue to raise capital into the city funds. So even as a publicly listed vehicle, if we get to that point, we're going to look to continue to grow, because the diversification and the economies of scale that come along with growing these portfolios is a benefit to investors.
Interesting. So that speaks to my final question, which is about your long-term goals for city funds. It sounds like you're really looking at a variety of cities all across the country and giving people that access to invest. So where do you see this in 5 years?
We think there can be a city fund for every major market in the U.S. and potentially for major markets abroad as well. And the vision is for each of these city funds to be publicly listed and traded with significant assets within each city fund, and provide a very simplified investment vehicle for people that want exposure to a specific market.
Fantastic. John Aristo, anything else to add on that?
No, we're pretty well in sync. So I think that that future envision is certainly shared. Some of the early discussions around bringing city funds abroad. There's some very interesting opportunities there that continue to balance this option for NADA as a means of introducing a financial product that provides a consumer good while concurrently, unlocking an asset class through this investment platform that's democratizing an asset. So that combination of, a good purposeful product along with a financial product, an investment product that's democratizing this asset is certainly something that will continue to grow and evolve within these products as we scale.
Fantastic. Well, thank you, all of you, for your time. A reminder to listeners, you can learn more about City Funds at joinnada, that's nada.com/cityfunds. You can always email us at media@millionacres to share your thoughts or ask us any questions. Stay well and stay invested.
Thank you for tuning in to the Millionacres Podcast. I hope you liked today's show. If you enjoyed this episode, please consider subscribing through your favorite podcast provider. If you have any questions, please feel free to drop us a line at help@millionacres.com. Stay well and stay invested. People on this program may have an interest in the deals, offerings, or services they discussed at Million Acres, or the Motley Fool may have a formal recommendation for or against. Always consult a certified tax professional before acting on tax advice, and do not buy or sell assets based solely on what you hear.